All right, guys, welcome back. It is 7 o'clock on my time here, and let's get started. A couple things. I know looking at the class, we've got 8 people in there right now, and so let me talk about a couple things for a few minutes and see if anybody else logs in, and then we'll proceed and we'll see where your questions are at. So again, we've been spending, I guess last week was chapter 4. And again, just to kind of some things about chapter 4, remember the due date for the chapter 4 assignments is Sunday, October 18th. So you still have until you have the rest of this week up till Sunday to get your assignments and Connect submitted. Again, that's for chapter 4. And again, there's just a couple things I want to go back over to recap it and also to see if you have any other questions with chapter 4. We'll do that at the start. And then the other thing tonight that we're going to get into is we will start chapter 5, which is the concept of adjustments. And I'll show you what they mean by that. And so we'll get into that a little bit later. And then my goal is hopefully to get into a few of the Connect homework problems and actually work them out with you, kind of go through exactly what they're wanting you to do. And also to explain again the concepts that they want you to get down in chapter 5. And so that'll probably take us up till the late night tonight. I don't know that we'll get it all in, but we'll get a lot of it in. But in terms of the due dates for the chapter 5 assignments, just kind of peeking ahead there, those of course won't be due until at least the 25th of October. So yeah, I won't, this week is kind of recapping, finishing 4 and getting into 5 tonight. The due date, I already put up the due date in Connect, but if you look at the due date for chapter 5, it says like December 13th. And so that's going to be updated, but I'm just kind of thinking ahead. That due date will probably be most likely October 25th. So, once we kind of finish tonight, probably what will happen is next week at our meeting we will recap chapter 5. And then of course, kind of get into chapter 6. So there's always going to be a little bit of overlap each week where we're either finishing up the previous week material and then starting any new material, and that kind of works best for these classes that only meet like in person once a week or virtually once a week. So that's the plan for tonight. Are there any questions before I get started tonight? I do intend to go back to one problem from Connect in chapter 4. I'm going to put up this in the screen in a minute, just to recap the concept of a journal and a ledger, and to make sure that you're following exactly what they want you to get down in chapter 4. And then I want to show you how we're going to take that to the next step in chapter 5. But I can tell you earlier, I've already received a few emails from students with any issues with chapter 4, whether there was a technical glitch, and this of course was from my other classes. Sometimes the website goes down. So I'll just kind of take any questions to start tonight before I get started. Any issues, anything from chapter 4? Specifically, does anybody need me to go back over or talk about? Jay, you got a hand up, Jay. Go ahead.
So I specifically remember when I was doing homework, I did send you an email about it. And it was...
Yeah, can you refresh me on that? I'm sorry.
Yeah, no, you're fine. So it was chapter 4 homework. It was question 9.
Okay, let me bring that up. Hold on just a second. I'm in the Connect. Let me go ahead and hold on just a second. If I pull it up, that way it'll be easier. And anything that you ask, sometimes that's actually pretty good for the class too. So let me do that. Hold on just a second. Let me get the right button. All right. So again, where we at? Chapter 4. And you say it's homework problem number 9, right?
Yes.
Now this problem I'm going to bring up, this is going to have all the solutions, but you guys already have the answers to these anyway. But
so
okay,
my
go ahead.
My general journal, I had everything input wise correct. Like I had no issues with putting the corrections or anything in the general journal. It was the analyze portion of the question that I could not for the life of me get correct.
Okay. Let's take a look at it.
I agree. It takes me like 2 hours to find that.
Oh,
Like I put
okay.
increased.
Analyzing was like the hardest part.
And it was
Okay.
the only one that I had trouble with
Okay.
out of the whole homework assignment.
Well, let's take a look at it. So let's go back first. Let's look at, before I answer that, let's look at the correcting, these were correcting journal entries.
Mhm.
And so let me get my arrow on. It's easier for me to point this out. So it looks like there were 4, they did 4 separate entries. Of course, on April 30th, that was essentially the same problem, but they just did the same transaction twice because they got it backwards. So essentially we've got 1 correcting entry here, and then here's a couple more, and then of course the end. So before we get to the analysis part, just looking at the question, I believe the question was asking, let me look at it, something about, it says, what effect do the correcting entries have on the company's reported assets? So if you go back and look at the correcting entries, I believe what they were trying to go with on this question was to see if you, it's kind of going back to the concept of classifying accounts to make sure you know what accounts are affected. So for example, on this first one, where it says you debited accounts receivable and they credited accounts payable, and that was to fix the entry. Well, accounts receivable is an asset and accounts payable is a liability. So if we were to answer that question, if we only had 1 correcting entry, for example, and they had said, what would be the effect of the correcting entries on the company's assets? You would say that the company's assets would have gone up by $15,800. I'm just, again, qualifying it, if that was the only question. But of course, we've got several of these we gotta look at. So I believe what they want you to do, going back and looking at that question, is you have to look at all your correcting entries and see which correcting entries impacted an asset account. Okay, so on this first one, accounts receivable is an asset and accounts payable is a liability. So we don't have to worry about that on this question. We just need to worry about this asset. So for this first part, you'd say, well, looks like this asset account went up by $15,800. Now, again, that's just part of the answer, because when we look at these two, you've got telephone expense twice. Again, that's not an asset, that's an expense account. And then we've got cash. See, that's 2 cash. So you've got cash, which is an asset, that was credited for $600 and $600. They did that twice. So in that case, your total cash, which is an asset, just on these 2 entries, would have decreased by $1,200. And then when I look at this last one, you've got accounts payable, which is a liability, and then you've got cash, which again is an asset. And of course, that went down, it got credited by $9,100. So if I were to write this out, this is how I would have looked at it. And then we'll get back to the actual answer. Is I would have written out like this. I would have said, okay, in terms of our assets, let me get my stylus on here. I would have gone through each of these and I said, okay, on this first transaction, it looks like accounts receivable increased because it got debited by $15,800. So that would be a plus. On the second and the third entries here, it looks like cash went down by $600 on both of these. Again, the arrow just indicating that it went down. And of course, I'd put a minus. And then on the fourth entry, it looks like cash, which again is the only asset account affected, went down by $9,100, which again, I'd put a minus. So in that sense, I would take $15,008, which is an increase. And then I would then subtract these 3 to get the net effect. And I believe that's what they were asking. And so now if I go back and look at, let me change my style. If I go back and take a look at what they wanted you to do, and I'm just going to show this. This looks like it's right down here. This is the actual answer. It says, after the correcting entries are posted, assets are increased by, and they wanted you to put 6,100. And they're showing you right here how they did that calculation. They took 15,800. Oh, it looks like,
Yeah, why is there only one 600 that's being minused?
Yes.
Because
let
I
me look
could,
at that.
I kept getting 5,500, but
Yeah,
it
me
kept
too.
telling me it was wrong, and I'm like, how?
Let me see. Oh, I see.
So
I'm
I
sorry.
subtract only one 600 too. So
Yeah, I think that's actually an error then. I mean, I see what I see what they did, but the actual question says, after the correcting journal entries have been posted, what effect do these correcting entries have on the company's reported assets?
It would be a difference of
It
5,500.
should be, yeah. So I think that's an error. Yeah. So
okay.
I'll make sure. Yeah, I think
Okay.
I think what they're looking at it is, and I
It
think,
goes to 0, and then you minus 600. Okay.
but the way they asked the question specifically is total assets based on these entries would have actually gone down by, you guys say 5,500? Is
Yes.
that right?
Yeah.
Yeah. So in essence, it kind of comes back to this problem right here, because with a debited cash for 600 and then they credit for 600, it doesn't matter, because we're just looking in terms of what these postings, how they would have affected your accounts.
Right.
And
They're asking for the difference between the two.
yeah, it's weird. So I actually, and you know, this kind of stuff happens a lot.
Okay.
You could put a question and put it out to 3 or 4 different instructors, and they're supposed to do this kind of stuff. And they say, what do you guys think the correct answer is? And if they can get the majority of the people come up with the correct answer, then they'll use that as the answer. But every now and then there's mistakes that get made. So based on what I'm looking at, if this is the approach you would have followed, and you're saying that's not the correct answer, that's not what they're giving you, there's to be, yeah. So to me, it should have gone down by another 600. It should be 5,500 should be the correct answer. So I'll make a note. I'll make sure that nobody is penalized for that, by the way.
Less.
But clearly, based on, if you just look, and again, this is just keeping it really simple. Every one of these accounts, anytime you post this to your ledger, again, I'm just following, I'm not even worrying about a financial statement. I'm just looking at the account. Accounts receivable is an asset, that increased. Cash is an asset, that decreased. In other words, cash decreased 2 times here by 1,200. And then again, it decreased on this one again by 9,100. So why they didn't include this other 600 in there? And again, we're just saying, it says examine the above journal entries carefully and then prepare the correcting entries, which we did. And then the question clearly states, after the correcting entries have been posted, what effect do the correct entries have on the company's reported assets? They should have decreased by that net effect. It should have been 5,500. So not to draw out a complete proof, I don't think you really need to. I just pointed that out. I just said, okay, just go to these one by one. Asset, accounts receivable is an asset which increases. Cash here decreases again, actually 3 times cash decreases by 600, 600, and 9,100. And that's how you should calculate it. So I don't know why they left out that 600. I guess I'm trying to rationalize and figure out why they didn't include the other 600. And I don't know. I think it's just a mistake. So, but good question. Very good question. So yeah, I'll make a note of that and make sure you guys don't get penalized for that one. Let me write that down right now. As I'm doing that, think of any other questions with chapter 4 from anybody. Again, I'll fix that. Yeah, so does anybody have anything else going on with chapter 4 other than the correcting entry problem? On journal entries, ledger, what any of that stuff represents what?
No.
Let me pull up, since I'm asking that question. I think we did this one in class last time, or at least most of it. This was problem number 8, where they've got the journal. And remember, here's just to kind of summarize, guys, chapter 4, the transactions are not new. In fact, it's a repeat from really chapters 2 and 3. We're analyzing the same transaction, so that's not new. The only thing that's really new is the concept of the recording system, where a business or a company would have a journal system and a ledger system, and you need to know the relationship and the differences and the similarities between the two. So the journal, remember the journal is the first place. That's the first record of entry, the first point. So here's your journal, and all these represent all of the transactions that we would have recorded. They often refer to it as the original entry, the book of original entry. So for example, the first one, you can see they got the date, they debited cash, they credited capital for $70,000. And of course, the next one was prepaid rent debit, credit cash, and so forth. Now, again, we're still doing your analysis. You got the asset accounts, you're following the rules of debits and credits, all that's kind of review. But chapter 4, once you record this, then you post it to your ledger. And again, here's the summary. Again, these are all the answers, but notice this first posting was right here. There's that debit to cash. And if I would kind of page down, I'm looking for the capital account right there. There's that posting of 70. Of course, they give you the balance of 70. And so even though this isn't a T account look, this is the ledger again, I want you guys to all think about, or at least visualize and generalize that the ledger basically is kind of like your T accounts. Each account that a business uses, whether it's cash or accounts receivable, it's summarizing everything that's going on, and it's doing it from debits and credit perspective. The journal is where you record. The ledger is where you summarize. In each of these accounts, anything that's being recorded in the general journal will get moved over, or they call it posting, into the ledger. So for example, if I were to look at the cash account right now, this is at the end of the problem, they would show a balance of $46,425. So why that's important is, of course, the ledger keeps track of every account and the balances. If there's ever any dispute or discrepancy or question about what's happening in the company's financial statements, you can always go back into the ledger and look at individual accounts to figure out what's going on. So specifically with cash, one thing about cash is, if our balance in our ledger says $46,425, there's going to be somebody reconciling that with the actual bank statement. So the money, for example, that you have in the bank should be able to be reconciled with this $46,425. All these differences, the increases and the decreases, all these amounts should also be affecting a company's bank statement. So somebody would actually, make sure that the ledger balance at some point in time would also be reconciled with the actual bank statement. And then of course the rest of these, of course this problem didn't have all the accounts, but the rest of these, you notice you've got various accounts, you've got fees income, which is revenue, here's a couple expense accounts and so forth. Notice you've got the balances for each of these. So where I'm heading with this, and I'm going to come back to this in a minute, so I want to go back and just, I like to draw stuff out just to visualize. I do this all the time. So just to kind of give you the big picture here of what I want to look at tonight, where we're headed, is, so just remember, let's go back, and I'm just talking concepts.
Simba.
So remember the journal, that's the first record, that's the first place you record, is your debits and credits. And then from your journal, you would then post to your ledger. All right. So again, I'm just saying think T account. Again, keep in mind, you could work at a couple different companies and your ledgers could physically look different than what we're showing you. But as long as you understand the concept, that's what you need. So for example, the ledger, you could have, cash, AR, and so forth. Now, the one thing that's missing here, and we're going to try to get to that back to chapter 5 tonight, is remember from the ledger, eventually we will then get to the financial statements. Okay, which by the way, you've already been tested on these, you've already prepared those in the first 3 chapters. But we're going to get back to that income statement, and my stylus is off here, the equity statement, and of course the balance sheet. Those are the 3 we're doing this semester. So we got 1, 2, 3. Okay, so the idea here is the financial statements, and an accounting system is basically being taken from the ledger, your ledger accounts. So remember, accounting is really all about organizing. How do you organize a business, you know? And you've got to have a system where you've got structure. If you don't, you're not going to know what's happening. And you could just bring up some of the biggest companies, and even right now in this pandemic, you know, think about some of these companies that are thriving right now. Anything online is super hot. You know, Amazon, you know, companies like Facebook, you know, they make billions of dollars. They've got to have an accounting system with structure. So all these businesses will have a journal. They're going to have a ledger, and then of course they're going to have financial statements. So my focus though in chapter 4 was, it's not necessarily was the financial statements. I wanted to make sure you got this concept down of what is a general journal and what is a ledger, because they're two different things, but they're related. The journal is where you start, and then you post it to the ledger. It's from the ledger that you prepare the financial statements. Now, in a minute, where we're going to head tonight is, we're still going to be working with journals for the rest of the semester. The concept of a journal is the same. That's going to be where you record your entries. And then we're going to post the ledgers. That's not going to change from now on. But eventually what will happen is we do need to prepare financial statements, because that's the goal. You have to, you know, summarize the data into some sort of meaningful form so that you can make decisions. And so what we're going to get into tonight is we're going to do some adjustments. In a moment, I'm going to transition, if, you know, in a minute, if there's no other questions. But we're going to do the same idea tonight in a way, but we're only going to look at specific types of entries before we are required to prepare the financial statements. Because when we get to the financial statements, the idea is, for example, when you've got an income statement, and just go back and look at any income statement in the textbook, look at any example, every financial statement will have a date on it. It's all about time periods. So if we said income statement for the month of October 2020, okay, that means something. That means that we're saying on an income statement, we would need to know the revenues and the expenses that were recorded or should have been recorded in the month of October, okay? And so that's kind of what we're going to be leading into tonight when we get there. Is we still have the journal ledger, which hopefully that's going to be you're pretty comfortable with that after tonight, or even going into chapter 5. We're just going to add a few more entries tonight in chapter 5, which is called adjustments. And the purpose of that will be because of this thing called the time period. Okay, so I'll pause here for a quick moment. Let me check on something real quick. I want to make sure, sometimes I get a question. Make sure a couple of chat. Okay, I'll get to those a little bit later. A couple of people sent me a chat, and I will get back to those in a minute. But so tonight, the theme will be, we still have a journal, we still have a ledger, those aren't changing, but there's one more thing we really need to do according to GAAP, generally accepted accounting principles, before we can actually prepare these financial statements. And the problem is because of the time periods. So what happens in industry is typically a business will look at their operations in terms of distinct time periods, months. Every month you'll do a financial report. So for the month of October, you might have an income statement, an equity statement, and a balance sheet prepared for the month of October. You'll do that every single month, because you don't want to wait until 12 months later to figure out that you're losing money. So every company typically divides their financial statements usually into monthly reports. And it's because of that we have these time periods, that when we get into chapter 5, and in a moment I'll show you a little bit about the PowerPoint, we're going to look at what is called adjustments or adjusting entries. So what's going to happen is there's certain accounts in the ledger that we need to adjust, because if we do not adjust those, our financial statements will not be correct. And one of those, I think the first one they show you will be that account called supplies. Everybody hopefully knows what supplies is. You know, supplies, of course, is an asset. And if you look at the definition of asset, what an asset is supposed to do, an asset is a benefit to the company. The company uses it as a resource to earn money. And what happens is, you first buy supplies, and we said this from day one when we started looking at accounts and classifying, we said supplies is an asset account. And if I were to ask anybody right now, and I say, okay, if supplies is an asset, and you looked at the 3 financial statements, which financial statement would supplies show up on? Where would you put supplies?
Income statement.
Balance.
No.
Okay, and well, it's not the income statement.
Balance
It's the balance sheet.
It'd be the balance sheet.
Yes.
Of course, why is it the balance sheet? Because the balance sheet is your accounting equation. It's your assets equals your liabilities plus equity.
Yes.
Okay. But here's the problem. If I bought $1,000 of supplies on October 1st, right? Let's say on October 1st, I just keep it simple. I have $1,000 of supplies in my ledger. Let me write this out right here. I got $1,000. Let's say on October 31st, when I'm going to, after October 31st, when we get into November, you'll do a monthly financial statement on the month of October. What if we said on after October 31st, we counted the supplies cabinet and there's $500 of supplies left. So that would mean then, if we start with 1,000 and there's 500 left, that of course would mean that we used $500 of supplies. And what's going to happen with that is we're going to say that usage of supplies is going to become, or it's going to be called, that's going to be an expense. Okay. So what happens is, for some accounts, they first start out as an asset, okay, and they're on the balance sheet. And then eventually, at some point in time, once you start to use some of those assets, you have to make some adjustments. And supplies is going to be one of those. And so when we make an adjustment to supplies, we need to show that the ledger says we've actually used $500 of supplies. We're going to do an adjustment and say, okay, if we've used $500 of supplies, we have to move that somewhere, where we're going to take that $500 and we're going to move it into an expense account. It's going to be called supplies expense. And the only way we're going to do that is by making an adjustment. And we'll do a journal entry. We'll do a post to the ledger. And then once we do that, once it becomes an expense, guess what? That expense will then get reported on the income statement. And in Chapter 5, we're going to do these type of adjustments for 3 different accounts. They keep it pretty simple to start. I like that they do it this way. So we're going to do like an adjustment for supplies. We're going to do an adjustment for the prepaid. Sometimes you had prepaid rent or prepaid insurance. And so we'll show you how to do some adjustments on those. And then the other one is that we're going to do an adjustment on equipment. So all of the adjustments that we're going to be doing in Chapter 5 are going to relate to expense types of adjustments. Okay, again, I'm just talking overview right now. We're going to go back over all of this, but I just want to emphasize that this thing, which is called a journal, and then you post to the ledger, that's still in play. In fact, that'll be in play for the rest of the semester. That's not going to go away. But hopefully after Chapter 4, which when we get into Chapter 5, when we start to do some of these adjustments, is that what we're doing is we need to update some of these ledger accounts before we get to the financial statements, because if we don't do that, then according to the accounting rules, which is GAAP, our financial statements will actually be incorrect. Okay. And again, we're only going to do 3 different types of an account adjustments in Chapter 5. What's going to happen is near the end of the semester, when we get into Chapter 12, we're going to do adjustments for everything. We'll do adjustments for not just expenses, but also for revenues. Okay. And so that'll be kind of fun when we get to that part. We'll get to a lot more in-depth thinking. But for now, just keep in mind where we're headed tonight is because of time periods. We have to look at the dates. And every time we do a problem is we'll look at some of those time periods. All right. So again, that was a little bit more of a preview than I wanted to go into, because I'm going to show you the PowerPoint in a moment. But were there any last thoughts or questions? Is everybody, I guess, kind of getting, even if you haven't submitted all of your chapter 4 assignments, does anybody else have any other specific issues like you know, somebody had with, Jay had with, like a few of you had with that homework? Is a good question. Does anybody have anything else with just chapter 4 before I put up the chapter 5 PowerPoint, and then we'll get back to these time period adjustments? Is anything, anybody, anything? And if not, that's fine. But a few people had, I think maybe I've answered everybody's questions up to this point. Okay, so let me do that. So keep in mind what I just wrote up, that's pretty much the kind of the stuff we're gonna be doing again tonight. And I'll remind you, because I'm not gonna go through I'm not gonna talk every single slide tonight, but remember, I think it's always a good idea to watch my lecture video. I think that'll give you more insight to what we're doing. So I just shared this. This should be my PowerPoint. All right, I think I got it up. So chapter 5. So a couple things I want to get into it. And again, watching my time. And I think after I get through with this will probably take us up to probably a little past the 8 o'clock hour, which will then take a quick break and then we'll get into some problems. But pay attention to this stuff because there's a couple things I'll talk about when they talk about this thing called the worksheet. And I want to make sure you know that I typically don't test on the worksheet, but you need to know how to use this thing called a worksheet when you do some of your homework problems. And I'll try to do my best explaining what they do with it and why it's in this particular book. And also to explain to you that typically you're not going to use a worksheet in a real world. You'll use probably the computer to do a lot of it. All right, so where we're at right now, let me kind of summarize this. So we've actually done the journal entries. That was, they call it the step 2 of the cycle. We posted it to the ledger. And so we've kind of done all this up to this point. Now, when they go steps 4, 5, and 6, which is essentially what we're doing tonight, I'm going to show you how they do this thing called the worksheet. I'll bring it up in a minute. But this thing called adjustments is really the step we're on, is we're going to show you how to do some of these adjustments. And then at that point, we'll prepare the financial statements. I don't know if they just got it backwards, but typically you don't prepare financial statements until after you've recorded the adjusting entry. So again, I didn't make this particular slide, even though I like the little scheme. Typically, the financial statements will be prepared after you've recorded and posted your adjusting entry. So what they call steps 4, 5, and 6 is kind of like what we're doing in chapter 5. So looking ahead, eventually we'll get to step 7, 8, 9, where we get to the closing entries. That's going to be chapter 6. All right, so next slide kind of takes us into this thing called the supplies adjustment. I just talked about supplies. And remember, everything is about time period. So in this example, they use $1,500. I said 1,000. They use 50. What if you have $1,500 of supplies? And then at some point in time, somebody does an inventory count. They figure out there's $1,000 of supplies left. That means that they would have used $500 of supplies, which of course I just told you that's going to actually become an expense. Now, before I get to the worksheet, let me put up, this is what we would do with this. So let me bring up just a copy of a journal. So make sure you can see my journal. All right, so I'm just double checking that. I hate to start to talk and all of a sudden I know everybody's not seeing the right page. So here's just a sample copy of a journal. And if this were the case, what we would do is, I'm just going to type this in instead of writing out. We would say, we would be debiting supplies expense and crediting supplies for $500. Again, let me make sure I got the right, that's probably at 14, it's 12, right? So this right here is how you would record this in an actual journal entry. You would call this an adjusting entry. You're putting it in the journal. You'd be debiting supplies expense because you're essentially saying that you use $500 of supplies. So you need to show that as an expense. So you would then have to debit supplies expense and then credit supplies. So that would be the journal entry you would have to prepare. You'd still post to your ledger. And so I just kind of put up a couple accounts here. And I think the problem said that they had $1,500 of supply. So let's pretend this T account set up as our ledger. And so if this is what they had, and they said there was $1,000 of supplies left, once you post this adjusting entry to that supplies account, well, what happened then is you post it as a credit. So there's your $500. And then the ending balance of supplies would then be 1,000. So your ledger would be updated because you need to make sure that this ledger balance agrees with your physical balance. This $500 would be this adjustment that would be posted from your journal. And then of course, supplies expense would also get a posting of a $500 debit. And then at that point, now when you go to prepare your financial statements, that supplies expense would then be put onto that income statement. Okay, so just keeping this real, I'm trying to keep this simple. This is the sequence. You still record in the journal. This again would be your adjusting entry. You post to your ledger. Again, there would be your in other words, you're updating your ledger of supplies. And then of course, every time you do an adjusting entry, an income statement account and a balance sheet account will always be impacted every single time. You've got supplies expense, which is income statement, and you've got supplies, which is an asset, which is balance sheet. Notice that supplies is going down by 500 and your expenses are going up by 500. Okay, so again, that's just one adjustment, and there could be several types of adjustments eventually. That's kind of where we're headed later on. But for now, you could have several adjustments that, yes, the accountant or the controller or the treasurer, you've got to record these. Because if you do not remember, eventually when we get to those financial statements, you've got to look at the time period. You got to make sure that what happened in that time period is accurate. You're trying to measure it. And so there's a lot of judgment here. This isn't something typically that the computer is going to do all by itself. Okay. And so when I say 1,000 units of supplies left, I don't know some of your background, some of maybe you've worked at some places. Have you ever taken a physical inventory? Have you ever worked at a place where you're at a store or something and your manager, your boss, your supervisor said, hey, look, today's inventory day, or you have to go out and count inventory, and you probably hated it. I've had to do that several times in industry where we would actually go out to the warehouse and you'd have to actually, with your clipboard and physically count what is there. And maybe some of you have seen this, you've been at Schnucks or at the Deerbergs or Walmart, you've seen people walking through the aisles probably before, and they got the little clipboards and they're scanning stuff. They're actually doing a physical count. And you might be thinking, what are they doing? They're counting. It's all about accounting. Because at some point in time, they got to relay that back to the accountants and say, what do we have left? Because you got to figure out, in some cases, what did you use? And you don't know until you count it. So there's only so much that I call it AI, artificial intelligence, can do. You still have that human element that will always be there. Okay. All right. So again, back to this thing. Let me go back to that PowerPoint. So back to this particular problem. Again, this is on the PowerPoint slide. This is just one of the adjustments we're going to be doing in Chapter 5. All right. So again, $1,500, and I'm trying to expand upon what they're giving us. When they say $1,000 of supplies remained, you should be thinking, well, how do you know that? Well, because somebody counted it. Okay. And that takes time. Sometimes you just have to say, okay, 4:30 on Friday or 4:30 at the end of the month. This is going to be the day you got to count, and then you shut things down. You count it, and then you plug it in. You figure out what you used. Okay. Now, once you get that, what the book's going to have you do is they're going to show you this is how you would plug this into a worksheet. Now, a worksheet, it's just a tool that we're using. All right. Again, I do not test you on the concept of a worksheet, by the way. I just want to make sure you know how to use it when you go to do your homework. So look at this worksheet. Notice you've got a trial balance column, an adjustment column, adjusted trial balance, and then they got the income statement and balance sheet on here as well. So they've listed some initial account balances. Notice that the totals of debits equal your credits. So for this one adjustment, notice it would have been supplies. Notice they put an adjustment in the credit column here, which is 500, and they put adjustment of 500 in the debit column where it says supplies expense. So what's going to happen eventually is we're going to take everything in this trial balance column, and we're going to either add or subtract these adjustments, and then do an adjusted trial balance. And then at that point, that will then do the financial statements. And so, for example, right now, for supplies, you take this 1,500, you would subtract out 500, and you'd put a balance of $1,000 right here in your adjusted trial balance. For supplies expense, since you had nothing there, you simply take this 500 and you'd carry it over. All right. So it's not hard. So all you'll be doing is once you enter these beginning balances, you got to figure out which accounts we're going to be making adjustments on. You do the adjustments, and then we're going to carry it over eventually to these other columns. Okay. And my hope is we'll do a couple of these tonight in the homework, just to show you again the nuts and bolts of how to use a worksheet. But to me, the big thing is you need to understand where that $500 is coming from, and also why we are doing it. It's all about time periods. This $500 needs to show up in this month for the month ended. Okay. And we're going to do this for supplies. We're going to do this for prepaid rent, anything prepaid. And then we're going to also do this for an account called equipment. Okay. All right. Are there any questions so far? I'll pause for a moment on what I just showed you, whether on the journal entry or the ledger posting, or even on the worksheet. Anything do I need to go back over for anybody? I hope my video, my audio is coming better and better tonight. I think last. All right. Next, let me show you the next one, and then if something comes up, let me know. The next one is a prepaid adjustment. And so on this problem, it says that they paid $8,000. This was in November for December and January rent. They paid 2 months in advance. Okay. And then they said as of December 31st, 1 month had already been used up. So before I get to this, I'm going to go back to this $8,000. So kind of keep that in mind. They purchased $8,000 prepaid rent. They did this in November. This is for December, January. So let me try to illustrate this again in the journal and make sure I can get the right screen on. Okay. So here's what would have happened here. Let's go back to our journal. So let's pretend again that this is November, they said November 20th. This is what they would have done. They would have bought $8,000 of prepaid rent. So they would have debited prepaid rent for $8,000 and credited cash for $8,000. Again, this is in November. Once they post this to the ledger, what would happen is cash would get $8,000 credit, and prepaid rent would get $8,000 debit. Now remember, prepaid rent is an asset account. Cash is an asset account. So in the month of November, this entry would, of course, affect the balance sheet. Your prepaid rent would have went up by $8,000, and your cash would have went down by $8,000. Total assets unaffected, but you still have to update these before you do your financial statements for November. So what happens then, now that we're in December, in fact, we're on December 31st, we have to make an adjustment. This prepaid account, which shows what, $8,000 right here, we're saying that we used up 1 month. And of course, that's going to be $4,000, right? Because $8,000 for 2 months is $4,000 per month. So we know that 8,000 divided by 2 is 4,000. Our monthly rent is $4,000. So we would have to make an adjustment to prepaid rent updated for the end of December. So what would happen then is we would debit, let me give you the adjusting entry. We would debit rent expense, and we would credit prepaid rent for for $4,000. And again, this is for 1 month of rent expired. So what'll happen is once we post this, we put that $4,000 as a credit to prepaid rent and a $4,000 debit to rent expense. So when we go to do our December financial statement, we want to make sure that that $400 of rent expense would then get recorded and reported on the income statement for December. And the only way that's going to happen is we have to prepare this adjusting entry. Now, prepaid rent, which again is an asset account, right? So if we don't record these adjusting entries right now, remember, prepaid rent is an asset. Again, this $4,000 is an adjustment. So by preparing this prepaid rent now, once we posted this, would then have $4,000 left at the end of December. That would be our ending balance. And guess what? That ending balance would then get reported on the balance sheet. So what I'm trying to get at here is I'm just trying to do some analysis here. If we didn't do this adjusting entry, number one, our balance sheet is incorrect because we have $4,000 of assets that are overstated. And if we don't do this adjusting entry on our income statement, we would have expenses that are understated by $4,000. So therefore, we would be overstating our profit by $4,000. So I want to make sure you see this, that this adjusting entry, let me get back to my stylus. This is the adjusting entry that you would do for the month of December. And again, remember, this is an expense account, and that affects the income statement. And the prepaid rent is a balance sheet account, and of course, that affects the balance sheet. So I'm just trying to say we've got to do these. If we don't record these and then, of course, post them to our ledger, guys, our financial statements are wrong. They're incorrect, according to GAAP. And so it's pretty important stuff. You got to do these. This is done every single, not every account's going to be adjusted every single month, but it can depends on how big the company is. It depends. Materiality is also important, but typically these are done sometimes once every few months, definitely at least a few times a year. And this is the thing where your accountants come in. They have to actually do these. So let me go back to, let me find my PowerPoint. All right. So on this particular problem, that was the prepaid adjustment. So then when you would get to the worksheet, this is how they would want you to put this into the worksheet. Notice in the adjustment column, there's that credit of $4,000 of prepaid rent. And then of course, you've got rent expense right here. There's the debit. There's the debit of 4, there's the credit 4. So again, this is where they'd want you to enter that into the worksheet. So far, I've showed you supplies. That'll be one adjustment. And I'm just making a general statement here. Anything that says prepaid, you'll have this. Typically, it'll be prepaid rent or prepaid insurance, but anything prepaid, that'll be the second type of expense adjustment. And then eventually, I'm going to show you how they do the equipment adjustment in a minute. Okay. All right. Now, does anybody have any questions? I'll pause for a moment. Any questions on just the prepaid? So what I showed you with the journal ledger, or how you have to put this on the worksheet? Okay, nothing. All right. So the third type that we're going to do is this thing called depreciation. Now, let me go back to this. So that's going to affect what they call the equipment account. And when I say equipment, you got to have to realize this. Equipment could be machinery, it could be computers, it could be a whole bunch of stuff. But you're going to find out that typically items that are classified as equipment in accounting world is what they typically call our long-lived type of assets. Long-lived, meaning that they usually last for several periods. All right. And so we have to have a way to deal with this adjustment process, which later on we're going to call, the accrual accounting concept. But you have to remember is that once you start to use equipment of course is an asset. Once you start to use that equipment, you have to figure out, well, at some point in time, you have to expense it. And the way we're going to expense that equipment is this concept of depreciation. So if I were to ask anybody here tonight, and if I were to ask you guys and say, hey, if you had to write down a piece of paper, either take a quiz or an open book essay, and somebody said, define depreciation, again, notwithstanding how the accounting defines it, but if, based on your experience with depreciation, what do you guys think depreciation means?
Lose value.
Value, very good. In fact, that was the first, I was hoping somebody'd say that, Diane, I'm glad you said that. So, and you're not wrong. And we're taught, you buy, like, let's take an automobile. Typically you buy an automobile and then you later on you want to go trade it in and get a new car. They say, oh, it's depreciated. You're like, huh? Like, up. Yeah, that means it's gone down in value. And I can't disagree with that. That's one interpretation of it. And that's not a wrong interpretation. But I will also tell you from an accounting perspective, what we're going to do with it in chapter 5, it has nothing to do with value. Okay, so get this, depreciation in the accounting world, I'd like you to think of it in terms of it's an allocation. It's not a value issue. It's an allocation issue. Okay, so here's what's going to happen. Now, so yeah, thank you, Diane, for saying. I'm glad, because I was waiting to say. Sometimes it takes a while for somebody to say value, but I think just about everybody's thinking value, depreciation, something values. Well, in the accounting, what we're going to do with this tonight, notice we've got, it says the cost. Again, this is for the equipment adjustment. The cost is recorded as an asset, all right, and charged to expense. When they say charged, I wish they'd say allocated. I think allocated is a better word. Charge allocated to expense over the time the asset is used, just like supplies. There's going to be a usage time period. I want you to think of, and you probably see these things all the time now. You see, if you look up and down the street, you ever see an Amazon van or a UPS truck or a FedEx truck or DHL driving up and down the streets delivering products? It happens a lot now, not that it didn't before. Well, guys, those vehicles, those are assets. Those are equipment. That's equipment, vehicles. And so at some point in time, if you're UPS or Amazon, you've got to charge or allocate the cost of that equipment to an expense as you're using it, because why do they use those vans and trucks? To make money. They're delivering the product. That's part of the cost of business. So depreciation is going to be the tool that we're going to use to make the adjustment. In a moment, I'm going to show you the formula. So again, it's all about time periods. And of course, in this particular slide, you notice notice it says asset pi, then you've got expenses and all these different years. Well, we have to have a way to allocate that. And the way we allocate that is by this thing called depreciation. Okay, so this is the accounting rule. The accounting rule does not say depreciation means an asset has declined in value. The accounting rules say this is how we're going to allocate it. Now, next slide shows us how we're going to do that. The method that we're going to use is called the straight line method. Okay, it's called straight line depreciation method. So can you all focus on this formula? The numerator says cost. Then you got this thing called salvage value. They take the cost minus the salvage value, and then they divide by the estimated useful life. So a straight line method looks at a product that has, or an equipment, for example, like a truck or vehicle, that these things do have limited lives. These vehicles are not going to last forever. At some point in time, they're going to have to replace them. So what happens is when they buy these, they record the cost. They estimate a salvage. Salvage value, by the way, means how much the equipment is going to be worth. And here, that is value, by the way. That part of its value at the end of its life. And it most likely it could be some sort of scrap value. The estimated useful life, if it's a vehicle, could be in terms of miles or years, but all of that would be measured when you first buy it. So what will happen is we'll plug it into this equation, and then we'll come up with our depreciation or our allocation. So on the next slide, we'll look at some amounts. So Here's how you do it. So in this particular problem, here's what they tell us. They tell us the cost was $11,000. The useful life they gave us was 5 years, or in months, it's 60. Again, these are just estimates. They said salvage value is 0. So all this information would be given to you in a problem, or you'd have to know this to do the allocation adjustment. So to get it, you take the 11,000 minus 0, and they divided it by 60 because they wanted the monthly allocation. So when they do this, they came up with $183 as the monthly depreciation. So once we do that, then you go back to the problem and you say, well, how many months of allocation do they want? And then you have to record the adjusting entry. Now on the next slide, they show you a new account. So you can see this account. It's called accumulated depreciation. Note that this is what they call a contra asset account as a normal credit balance. Okay. Notice the equipment is your normal asset account. Okay. So before I get to this, because this always confuses people, especially when you get to like an adjusting entry, guys, that equipment account never gets adjusted. Once you bought that asset, it's yours, it's the company's. The accumulated depreciation account, that's going to be the account you're going to use in your adjustments, because that's going to keep track of how much of this original cost you've allocated to an expense. So for example, let me go back to my journal. So let me illustrate. Let me get rid of this. So here's the simple idea. When they first bought that equipment, let's just say they paid cash. That equipment cost $11,000. And again, let me make sure I got the right screen on. Okay, so, all right. Notice I get paranoid about that. A few times I'll click to a screen and I'll forget to share it, and everybody's like, where are you at? So, but yeah, so you should see my journal right now. So notice that this is what would happen. You buy the equipment, and of course you've got $11,000. And then in your ledger, and let me just change this. Let's say we have equipment, and let's say you posted it, and you got $11,000 in your ledger. Okay, so at some point in time, once you start to use that, eventually we're going to depreciate or allocate. And let me just put this in. So you've got 3 accounts that are involved. So you got equipment when you first bought it. And then when you start to do your adjustments, you're going to use these accounts. You're going to use depreciation expense and accumulated depreciation. So in this particular problem, they came up with $183. So our adjusting entry would be to debit depreciation expense and then credit accumulated depreciation for $183. So this right here would be the actual adjusting entry. Notice you do not debit equipment expense. That's not the account. They want you to put it into an account called depreciation. Once you post this to your ledger, I just want you to see this. You're going to post depreciation expense to your depreciation expense T account, for example, and your contra account. Again, that's the new account. It's called a contra asset with a credit balance. That's going to go to your accumulated depreciation account. So when I post that, notice depreciation gets $183 debit, and accumulated depreciation gets $183 credit. Notice we do not adjust equipment. That's the account that stays on there forever. Until you get rid of that equipment, that stays there. That's called a historical cost. The accumulated depreciation is the account that keeps track of how much of this 11,000 have we actually allocated. Okay, so if this is after 1 month, I think if we just say in this particular problem, again, just for illustration purposes, so if this was December 1st, and Now we're at December 31st. This would be the sequence right here. This is how it would work. You bought the equipment right here, and then this would be your month, your adjustment at the end of the month. So in your ledger, this is what it would look like. So that brings up one more thing, and then we'll see if there's any questions. Once you do that, another concept that comes up is called book value. So I know Diane mentioned market value. The only value that they're going to talk about as it relates to this concept is what they call book value. So what they mean by that is if I were to say, what is the book value of this equipment? Here's how you do it. You got equipment, and then you have accumulated depreciation. You would take that $11,000 and you would subtract $183, and you would get what's called a book value, if I can type right, of the difference. You would say your book value, and I don't know why, I know why I did that, hold on. You say your book value would be $10,817. Let me get rid of those decimals. All right. So that would be called book value. And all you need to remember right now for that, since I haven't gotten to the balance sheet yet, is that's going to be what's going to show up on the balance sheet. Your balance sheet will show equipment at 11, and then it's going to show that accumulated depreciation. I put a minus here just so you know a contra asset is going to reduce the total assets. So in other words, book value is always the cost minus that. That's going to be the presentation eventually when we get to the balance sheet. Okay. So if I go back now, let me show you how the PowerPoint shows it to you. Show this to you. So you'll notice right here, when they talk about book value, how they've got, my mouse disappeared here. How they've got, there's your accumulated depreciation. And down here, they got the original cost minus the accumulated depreciation to get that $10,817. This, again, historical cost does not change at this point because that's going to be on there forever because that's what you paid for. Okay. And then I want to show you this. Then on the worksheet, let me go back a slide. On the worksheet, they would want you to enter this depreciation. There's the 183 right there. And then there's the accumulated depreciation entered as a credit. Okay. So here's your adjustments. They got 3 of them. Notice your debits equal your credits. So eventually you're going to have to enter these into a worksheet, but you still have to know which accounts are debited and which accounts are credited. And of course, which accounts are make sure you're using the right accounts. Okay. And that's what we're going to do after our break tonight. We'll get into some of the homework problems. I'll show you how to do this in the journal and the ledger, and then we'll do a couple worksheets. And then eventually we'll get to the financial statements. But this is an important step that you always have to do before you actually prepare financial statements. All right. Now, does anybody have any questions on what I just showed? Yeah, go ahead. Somebody had a question. Yeah.
So the depreciation expense on the equipment is it always a debit account?
Yes. Depreciation expense?
It's always a debit account.
Yes.
And the other one is always a credit account.
Yes.
Okay.
Yep.
And this is only for equipment, right?
Correct.
Okay.
Okay. So can it change if it's a different item? Can it become a credit? The depreciation expense become a credit?
No. The only time we're ever going to credit an expense, well, for us, let me qualify this because there are some different ways you could do adjustments. Eventually, you could do some credit. The only time we're going to credit an expense account, at least in this class, is in Chapter 6 when we do what they call the closing. So for right now, anytime we incur an expense, it's always going to be debited. Now, let me show you guys something. And I think that this is gonna add on to this question you just asked. So this is 1 month, right? So for this problem right here, what I just showed you here, this was December 1st to December 31st. We did 1 month of adjustment. This is an adjusting entry for the month of December. So if we went to the, let's say we went to January. So let's say now we're in the month of January. We need to do another adjustment because we've used 1 more month of the equipment. Well, guess what? We're going to have the exact same entry. It's still going to be depreciation expense, credit accumulated depreciation, and it's still going to be for $183. So notice we've got, I'm just showing you the next month. So this would be the first month right here. The second month, notice it's the exact same entry. Again, this is the straight line method. So this would be for the month of, January's financial statements. So how would that impact our ledger? Well, you'd go again to this accumulated depreciation account, and guess what? You're going to tack on, you're going to add on another $183. So after the second month, we would now have 2 postings because we'd have 2 months of usage of $183 of equipment use. Now, if I added those up, that of course would give us $366. So then therefore our book value would now be at $10,634. So 1 month, again, that's what the entry would be. The next month, it's the same entry, but I want you to see this is how it would impact your ledger, because this accumulated depreciation account, think of the word accumulate, it's going to keep adding up every time you depreciate. Every time you depreciate, you're going to add another $183 to that number. And then look at your book value is going to go down because it's going to be increasing. So I hope that explains it, because depreciation expense, when we do these adjustments, will always be debited. Yeah, go ahead.
Okay, so the depreciation expense that you have, you don't add to that while you're adding to the accumulative depreciation.
Well, just think of it.
Absolutely.
Each month you're going to have a new adjustment. So let me just draw a line here. So these adjustments right here, this, let's pretend this would have been for the month of December. This is December's report. Now, let's say we're in the month of January. That's a totally separate month. We're going to use these same accounts over and over again. Okay. And eventually what we're going to do in chapter 6, and we're not doing it yet, is every month you do what's called a reset or a close. Every month you reset these accounts so that you use them again.
Right. Okay,
so,
okay. So
I mean, you're on, go ahead. Yeah, go ahead.
it would actually be like the one for January 31st will actually be in the general ledger for the month of January.
Correct.
Right. So then, okay, I get it.
And then every month, when if we did February, or if we did March, this is going to be the exact same entry every single month, month. And then you post it, and then eventually this accumulated depreciation, it's going to keep, that's the account that's going to keep increasing. Okay. But here's the thing to think about. The adjustment that I just showed you on straight line, because it's such a very, a lot of companies use this method. Most of this stuff is automated. Nobody's sitting around doing these calculations manually. Typically what happens is you have the computer software, you'd enter in the components, you'd enter in the cost, you'd enter in the time periods, and then once you enter that, it's going to automatically calculate it for you, and then it's going to record everything for you. Nobody's going to be sitting around doing what I just did. So when I just type these in, like I did right here, just for illustrative purposes, all this stuff, once you plug it into a system, all these things will be done automatically and posted automatically to your ledger. So it's you as a supervisor or an accountant analyst is to understand what's impacting your ledger, because sometimes stuff gets in there that's not correct, and you need to understand where it's coming from. So it's nice to just show you this is the basic idea. Journal goes to ledger, and understanding how these things are calculated, because I can tell you back at least, when I was in industry, I had to do a lot of manual entries, but a lot of the stuff we did, most of the time, believe it or not, was just looking at corrections and mistakes. Because when we go to do our analysis, we knew something wasn't right when we did our financial statement analysis. Either our income was too low or too high because we would compare it to a forecast. We'd have to go back into our ledger and look at journal entries to see what happened and try to analyze, what increased, what decreased, because something just wasn't right. And you really had to understand how everything worked, because at some point in time, just like we did in chapter 4, you have to go in and make some corrections. But big picture, you still have to understand how all this stuff impacts your financial statements. It's pretty important stuff. So what happens here then, going back, is, and by the way, in terms of chapter 5, typically we're only going to have you do like 1 month. They're not going to make you do 5 months, 6 months, because what could happen is, this would be a good test question, by the way, is they could say, okay, after 1 month of depreciation, what's the book value? Well, that would be easy. You just take 11,000 minus 183. But what if they had said, what would be the book value after 4 years? Well, you'd have to do 4 years of depreciation and then subtract that from the cost. Now, again, I don't do that. I'm just saying, just understand, as long as you can understand 1 month and understand that this book value would be updated every month. For example, if we're doing it by the months, if we said since I have this up, if we said after 2 months, and I were to say, what would be the book value? You'd say the book value is 10,634. Okay. I don't believe you're going to encounter that in any of the homework problems, but since I've got this up just for learning aspect, I don't think it should be too difficult to understand, but I think it's a good thing to bring up, because I think this does come up in chapter 12. I think you have to do a couple more months and they'll ask for book value. But for now, just understand that accumulated depreciation is the balance sheet account that's impacted, and depreciation expense is the income statement account that's impacted. Okay. All right. Now,
I've got a question.
Yeah.
Yeah. In reference to the depreciation expense, that number stays the same for each given month.
Every month.
But the accumulated depreciation goes up in terms of, as we move along, in terms of the months, as an accumulation.
Remember, accumulated depreciation is on the balance sheet. Okay. Depreciation expense is on the income statement. And what's going to happen is when we get to chapter 6, okay, chapter 6, what's going to happen is, and I tried to say this earlier tonight, we're going to do we're going to reset or zero out all of our expense and revenue accounts. I'll say all of our expense accounts, we're going to reset them so that when we start any new period, they always start with 0. Okay. So if this was our only depreciation expense for the month of December, so if this was our only entry, so when we go into January, this depreciation expense would have a 0 balance, and we're going to add another $183 because we're going to put that number again on the income statement as $183. Okay. It'll be easier probably to see for that question once we've completed chapter 6. But just to try to explain this right now without confusing anybody, this depreciation expense every month, this is the entry. It's going to look exactly the same way. And this expense gets reported on the income statement. And then the accumulated depreciation, which is on the balance sheet, it's a contra asset with the credit balance. Every month, it's going to go up by $183. Okay. So was that Daniel that asked that question? It's a good question.
Yes, sir. Yes,
Yeah.
it was.
I don't think I'm answering it as best I can, but without showing you the closing entry.
No, I understand what you're saying.
Yeah, okay. But it's a really good question. I mean, I want to go there right now, but I don't want to, if I do that, I'm going to kind of get into, I think I mentioned this earlier in the semester, where they brought up the concept of what's a permanent account versus a temporary account. And I guess I'll mention this a little bit right now. And that kind of is the best way to kind of answer this question, is that expense accounts are what they call temporary accounts, meaning that you're going to use them over and over again. So every month, typically you reset them. And then your permanent accounts, which are basically on your balance sheet, those never get zeroed out. Those get updated. And this accumulated depreciation would be what they call a permanent account. So this accumulated depreciation would permanently record or accumulate everything that goes into depreciation. Even though every month you're resetting these, this account will keep track of that. That account's not going to get reset. Okay. This account will keep track of all of your depreciation adjustments. Okay. And that's probably the best way I know to answer that question, at least at this point. Okay. All right. Let me go back. One more thing on the PowerPoint, if I can get back to that. Let's see if I can get. All right. So once we've done that, and we'll do again after our break, we'll get into the Connect homework. So once we've done that, you've got book value, which I just talked about. And then eventually, just to kind of mention again, the worksheet, again, we're only using that in this class. It just, you know, I didn't used to use them in my in-person sessions just because I know that you do not actually use a worksheet in the real world. But for the virtual setting, the only reason I'm using it is because I honestly believe when you complete some of the homework problems, it's actually going to help you get it down. It'll actually make sense to you. And it's just kind of like the T account. You never really do T accounts in a business setting either, but you still understand it. So just think of the worksheet. It's just, we're using it just to get to the financial statements. In the real world, you'd hit enter on your computer and it's going to do it for you. So this is just going to be a way just to try to give you a picture and a visualization of how you connect the dots, to show you how, here's how you go from a journal to post to a ledger. This is how your adjustments affect the financial statements. And if you can understand that, you'll be in pretty good shape to understand the basics of this accounting cycle. All right. All right. Now, I think that's it in terms of what I wanted to show you on the PowerPoint. And looking at our time, it's 8:16. I think it's a good time to take a 10-minute break. So let's do that. Come back at about, let's say 8:26, 8:27 roughly. And when we do that, I'm going to bring up the Connect homework. We'll get into Chapter 5 homework, and I'll work some of these problems out, and I'll show you how you got to do the work. I'll show you how to enter the stuff into the worksheet as well. Okay, so let's do that, 10 minutes, and then we'll come back, and then we'll get into the homework problems. All right, looks like I got 827. I went ahead and shared. Let me make sure I got the right screen on here. I've got, this is my Connect page. So what I'm gonna do here in a minute is I'm gonna get into Chapter 5 homework. I'm gonna bring up the student view. So this will be the view that you all see. And then I've got, I know that there's a total of 8 problems in Chapter 5, and I don't want to do every one of them, but I'm going to go through at least the first 2 or 3 of these and do some pause and just to see if you have any issues on what I'm showing you, and then we'll kind of see where that takes us. So let me switch over to the student view. And then again, this is going to be the Chapter 5 homework. And let me move this. Hold on just a second. Let's begin that. All right. Bring up my, I'm just adjusting. So I got different views and what I can see everybody's, make sure we're all in there. All right. So this is how problem 1 looks. And they're going to give us, these are going to be the 3 different types of adjustments that I showed you in the PowerPoint that you're going to be responsible for in Chapter 5. They all are related to asset accounts and expense accounts. Every time we do an adjustment, one expense account is going to be impacted and one asset account will be impacted. So we'll do these one at a time. And in this problem, notice the requirements simply say prepare end of June adjusting entries for the Connor Company. Notice end of June, this is 1 month. This is the month. So always watch your dates. So we'll start with number 1. Notice it says June 1st, Connor Company, a new firm, paid $16,800 rent in advance for a 7-month period. It says the $16,800 was debited to the prepaid rent account. So what I'll do here, I'm gonna do a couple things. This homework problem only wants the adjusting entry, but in terms of trying to teach the concept of the overall big picture, let me go back and also show you how this would impact your journal when you first started. So in a minute, I'm going to bring up my journal page. We're going to go back and forth here a little bit. So I'm just resetting this. Just give me a quick second. Okay. Doing one more thing and then I'll get us over. All right. So they bought it. It's $16,800. This was on June 1st. So if we were in our journal, which I believe I got it out, okay, we would say, of course, debit prepaid rent, credit cash for $16,800. Now, no, this is not the adjusting entry. This is just the original transaction that's going to cause us to have an adjustment later on. So if this was June 1st, it is, there's our June. If we then post this into our ledger, then again, we got the prepaid rent. There's $16,800 that would be posted there. And of course, I'm not going to worry about the cash posting, but well, might as well put it up as well. Let's say we've got cash. That would also get posted as well, I guess, just to be consistent. Right. Although, by the way, when we do adjustments, whether it's Chapter 5 or later on when we get into Chapter 12, you're going to find out that cash is indeed never an adjusting entry. It's never involved in an adjusting entry. It could be involved, like it is right here, to buy prepaid rent, but the adjusting entry is going to involve prepaid rent and rent expense, not cash. All right, so there's our original purchase. The problem said that this prepaid rent was paid 7 months in advance, all right? And so the problem says the end of June adjustment. So the end of June, of course, would be June 30th. On June 30th, we've got to figure out how much would be our monthly rent. So how could we do that? We got $16,800. Of course, we divide 16,800 divide by 7. And does everybody see that would give us $2,400?
Yeah.
16,800 divided by 7. We are essentially saying our monthly rent is $2,400. So right now, if we look at our ledger, we don't have anything in rent expenses, zero, nothing. We have 16,800 in prepaid rent. So if we were going to do a June income statement, right, we need to take some of this 16,800 and transfer it to rent expense, and that's going to be what our adjusting entry does. So what we do then, I'll do it a couple places here. I'll type it in here. So we have rent expense debit, and then credit prepaid rent for $2,400. Okay, and then we're going to do the exact same thing, and I'm going to go back into Connect and we'll do the exact same thing, but I just want to show you this in one screen. So we got the adjusting entry there. You would then post it to your ledger. You'd have $2,400 being credited to prepaid rent and $2,400 being debited to rent expense. So this is the big impact. They don't do all this in problem 1, but I'm just showing you this is what's happening here. Here's your rent expense, $2,400 being debited, and then there's the credit of $2,400 going to that account in prepaid rent, which again is an asset. And then at that point, you take that 16,800, you'd update this balance, your balance would then be at 14,400. So if we just paused right here and said, okay, after this adjusting entry, if we were to prepare an income statement, we would now show $2,400 as rent expense. Okay. If we did not do this adjustment and then we wanted to prepare an income statement for the month of June, we'd be missing, in effect, we would be missing $2,400 of expense on our income statement. So therefore our income statement's wrong. And our balance sheet right now should show $14,400 of prepaid rent, again, after the adjustment. If we fail to do this, if we miss that, then our balance sheet would show $16,800 of prepaid rent, and of course that's wrong. Okay, so I'm trying to emphasize as we go, do this one at a time, that yeah, you got an income expense is an income statement, prepaid rent's balance sheet. Every time you do an adjusting entry, you always impact both statements. And then I also want you to think, what happens if you fail to do these? How your income statements are incorrect and they're off by these amounts. So you got to do these, because these will impact your statements. All right, now if I go back to Connect, here's how you got to do it. So in Connect, you go down, just like we did before, you find the little drop down arrow. I'm looking for rent expense right there. And you say 2,400 debit. And then I'm going to credit prepaid rent right there. And then remember, just like we did in chapter 4, you got to hit record entry. So I record it, and then of course, if you want to look at the journal, there you go, just like I typed it in. So that would be your first one, okay? And then of course, that's again preparing for the adjusting entry for prepaid rent. So again, before I get to the second one, any questions on what I just did or showed you on this type of an adjustment? Phil, question?
No.
Okay, cool. Now, so this said prepaid rent. If this said prepaid insurance or prepaid taxes or prepaid anything, it would basically work exactly the same way. We debit prepaid, and then you look at the time period for adjustment, and then in this case, we just divided by 7 because it was for 1 month. That was an easy one. Okay. All right, let's look at the next one. So the next one, and again, this is the transaction list. We'll record it. Let's look at part B. This one's going to be recording it for supplies. So it tells us that June 1st, they bought some supplies for $12,580. It says the $12,580 was debited to the supplies account. Then when they say an inventory of supplies at the end of June showed that items costing $9,275 were on hand. That means that's what's left. So on June 1st, you bought some supplies. So let's go back to our journal. Again, I like to show you from day one. Let me delete this. So on June 1st, you would have debited supplies, and we'll just say credited cash. Whether it's cash or accounts payable, that's not really the problem here. So we got 12,580 debit and 12,580 credit. That's to start. That's to buy the supplies. You then post it to your ledger. 12,580 would then go into that supplies account in your ledger. Now you get to the end of June, and the problem tells us that $9,275 of supplies were on hand. So simple calculation, I'm gonna type this in right here. So if you have 12,580 and you just used up, I'm sorry, and you have 9,275 left, type something in. Hold on just a second.
3305.
Yeah, you would just take that, subtract the difference, and let me make a note. That is what you used. Okay, Dan, you're right. So you used 3305. That's going to be our expense for the month of June. So our adjusting entry will go like this. You'd have supplies expense, debit, and then credit supplies for 3305. And then you would post it to your ledger. So supplies would get a posting of 3305. And then notice once you do that, once you update that account, notice then that 9275 should now be the balance that shows up in your ledger. And then likewise, and I'm just going to make this one supplies expense as I go. So then you have supplies expense that would get debited for 3305. Okay, so again, the impact here is, again, supplies expense gets posted and supplies gets posted over here. Notice that's an asset account. You're basically reducing your asset by updating it, and your supplies expense, you're adding that into your income statement. So again, you do a financial statement for the month of June. Income statement needs to include this amount. If you fail to record this adjusting entry, then your expenses are incorrect on the income statement and your income would be overstated. Your balance sheet, again, if you didn't do this, your balance sheet would also be overstated by 3305. Okay, so now if I go back and then you just go into the, you have to go into the Connect homework. I'm looking for supplies expense right there. Type in 3305 debit, and then type in supplies. It's right there. They don't have these in the right order. 3305 credit, hit record entry, and then view it, and then it'll look just like that. Okay. All right, questions on that part? Anything that I just showed you guys? Okay, third one, now we get to the depreciation. So on the depreciation, it says, again, notice the date, June 1st, they bought some equipment costing $108,000. The equipment has an expected useful life of 9 years and no salvage value. Most of the problems they give you in chapter 5, I'll just kind of give you a heads up. Usually they'll tell you no salvage value, but just in case, read it through, make sure you look for that number in case there is a number. It says the firm will use straight line method of depreciation. Again, it's 9 years. We only want 1 month of usage, okay? So again, the equipment cost $108,000. So let's say we went back to our journal and ledger. So again, June 1st, you would debit equipment, credit cash for, and I'm going to increase that. Okay, for $108,000. So again, you'd post this, you'd have $108,000 credit going to cash, and then let's just add equipment here. Let me delete these. So then you'd post $108,000 to your equipment account. Now, at this point in time, that's just buying the equipment. This is not the adjusting entry. This is just purchasing the equipment. We get to June 30th. We need to allocate, notice I say allocate, which is depreciate, 1 month of usage. So remember our formula. Just to remind you, stylus, the formula for the straight line method calculation. Right. Stylus turned around here. All right. Remember, it is cost minus salvage value. Divide that by the estimated life. So the cost in this case is $108,000 minus 0. Now, here's the key. When they say estimated life, this problem gave us 9 years. So you could do a couple things here. I would suggest you do this. I would suggest you take that 9 years and multiply that by 12. Does anybody know why I would suggest you do that?
Yes, why?
Well, that's the amount, that's the monthly amount.
Correct. Yeah, so if you do that, what's 9 times 12?
108.
108 months, you got it. So if you got 108 months, so what you would do then is if you divide essentially 108,000, divide that by 108 months, that's going to give you how much depreciation you have, or you're going to allocate that cost per month. Okay. So again, if you type this up, 108,000, I'll just do it here in the Excel, 108,000 divided by 108 would give me right at $1,000. That's an easy one. I guess you could probably do that one in your head. So our monthly depreciation would be $1,000. All right. So what we would do is go to our journal. And again, I'm going to type it in. You could have depreciation expense and accumulated depreciation. You're going to debit and credit for $1,000. Notice again, we do not debit equipment expense. I say that because I can't remember how many times I've either given a test or a quiz in class, and I have you guys, if we were in class, you know, I typically would have you write these out by hand. And I just know how many times every time I teach this or do this, I see an answer that's written down as equipment expense. Even after I've specifically said, do not use equipment expense, it's depreciation expense. So hopefully you get that. So that would be your adjusting entry right here. You would then go to your ledger and then let's post it. So we have depreciation expense, there's a 1,000. And then of course, accumulated depreciation, it's a credit of 1,000. Notice, again, notice, we do not have to post anything else to that equipment account. The adjusting entry, we go to depreciation expense, that's the expense. Accumulated depreciation, that's the contra asset. That's the account on the balance sheet that keeps track of all your allocations, okay? Now, if we stop right here and say, okay, after 1 month, what would be the book value? Well, the cost, which was 108, and then the accumulated depreciation after 1 month, which is 1,000. So it's basically $107,000 would be the book value after 1 month. Now that question could come up either on a quiz or an exam. So make sure you understand again how to calculate book value. And typically, at least on the next exam, whenever we get to it, I don't believe anything comes up where I ask you to do book value after more than maybe 1 month, maybe even 2 months. This one's an easy one. If we said after 2 months, it'd be 106,000. Every time you depreciate by a month, it's going to go down by 1,000. But you got to make sure that you get the correct adjusting entry, how to calculate it, and then I'm just trying to show you again how the posting would work in the ledger. Okay, so if I went back into Connect, you'd look for that drop down arrow. I'm looking for depreciation expense equipment. And then for the credit, there's the accumulated depreciation. You type in 1,000 debit and then 1,000 credit. Hit record. And then I'll review the journal. And those are the 3 types of adjustments that you're going to have to do. So again, I wanted to give you a look. I actually showed you more on my template and ledger than they're actually having you do in this problem. But I think it's a good time to talk about not just this specific adjusting entry, but also the concept of book value, and also just to try to kind of just reinforce that, yeah, these affect your financial statements. And if you fail to do these, that your financial statements are in fact impacted. They're going to be overstated in terms of income or understated depending on what that adjustment is. Okay. All right. Are there any questions about problem 1, which by the way is very similar to what's in the textbook? Any questions on any of these 3 different types of adjustments or what I just showed you?
Oh my God.
Okay, here's a question, and before I move on, here's a question. Let me go back.
Huh?
So I just said that book value is a concept of cost minus accumulated depreciation. Book value is what it gets reported again on the balance sheet. Here's my question. This equipment, which was purchased on June 1st, after 1 month, we've allocated $1,000 of the original cost to expense for our usage. Here's my question. This book value, which right now is $107,000, does that mean that we could sell this equipment right now and it's worth $107,000? Anybody? What do you think?
Yes.
Yeah.
It says yes. Anybody else?
Yeah.
Does anybody say no? So you're telling me that after 1 month, that this book value, which again, this is just on the balance sheet, is going to say the value is $107,000. I'm asking, what's the market value? What would it be worth if you sold it to the public? Could you get $107,000 for this equipment?
That depends.
On what?
Maybe not.
That depends on who's willing to pay more.
You're right. You're 100%. No, you're correct. But the point is it not necessarily, right? That 107,000. I mean, you're right, Dan. Maybe you could find a buyer for 107,000. Maybe not. Maybe you could find somebody that would be willing to give you more than 107,000, or perhaps less than 107,000. That's what you call market value. That's what the market's willing to pay. Okay. So I just wanted to ask that question just to see if anybody was thinking about this. Remember, depreciation in the accounting world isn't market. It's not the value. So just because they use the word value when they call it, book value, that doesn't mean necessarily that it's worth 107,000. But Dan, like you said, it's possible if after 1 month that they tried to sell this equipment, is it possible that somebody could give them 107,000? You bet. Most likely they wouldn't. But I'm just saying you could find somebody. Probably. I mean, it's possible. I'm saying it's not impossible. But the idea is, I just want to make sure you see the distinction. This is internal. This is on your financial statement. That doesn't necessarily mean this is what the market is worth. Just like when you ever heard of the Kelley Blue Book value with like the cars, with your automobiles, they always tell you the depreciation rates and how much your vehicles are estimated worth depending on mileage, and they always get condition and so forth. This is not that. This is different. This is just what's on the books. Okay, so if one thing hopefully you can get tonight, just talking about the concept of depreciation, is that first of all, it's an adjustment type of concept in accounting. We allocate, and it does not mean market value in the accounting world. Okay, outside of the accounting world, depreciation can take on a whole lot of different meanings for a whole lot of people, and I can't disagree with that. I'm just saying in this class, in an accounting setting, Depreciation means allocation of cost. Does not mean value. Does not mean a value or decline in value like we all think initially when we hear it. Okay. So I'm trying to make sure we get that distinction tonight. Okay. All right. That was problem number 1. And I think the next problem is very similar to this. Let's take a look at this one. I'm gonna do a couple of them. And there's only 2 of them on this one to make sure I got the right screen up. Let me go back. All right, so hopefully everybody's looking at this, and I'll give you a couple minutes on this one since I just kind of walked everybody through these. So this one, the first one says they purchased a 3-year insurance policy. Notice it's July 1st. They put it to prepaid insurance. And then the second one, they put it to prepaid advertising, okay? And then so they got 2 different types of adjustments, and then they want you to do the end of month adjusting entries for each of the above situations. So I've got, let me do this. Let me give you a couple minutes, and you just kind of do this, and I'll leave the screen up. And whether you got your own homework assignment pulled up or you got a piece of paper, pad and pencil, let me give you a couple minutes, everybody on their own individually. See if you can tell me, figure out what you think the 2 adjusting entries would be for numbers 1 and 2. And so I'll pause this for a moment. I'll leave it up. I'll give you guys, say, 5 minutes or so, see where you're at. We'll come back, and then let's see what you came up with. All right, we're going to go over it, but let me have you guys try it first, and then we'll take a look in about 5 minutes. So try to get these adjustments. I'll pause it for a second. I'll just let you try to work it out, and then just do your best. And we'll come back to about 5 minutes. Let's see what you came up with. All right, so I'm going to pause my video just so you don't focus on me. Just work this problem out, a couple problems. In about 5 minutes, I'll come back and let's see where you're at. All right, I hope I gave everybody enough time. If not, I apologize. But let's look at number 1. And again, all they want is the adjustment for the insurance. So my first question, and this is for anybody, is did anybody get the monthly amount? What should it be? Anybody?
$750.
Yes,
750. So 750. Very good. So what you did is, which is correct, is you would have taken $27,000, divide that by 36 months because
yes,
it's 3 years, and you should have come up with $750, and again that would be per month. So once you get that, the next question is what would be our adjustment? What account would we debit?
insurance expense,
Okay, so I would find insurance expense, debit, 750, and then what would we credit?
prepaid
insurance.
insurance.
Very good. Okay, and then of course you'd hit record entry. Any questions on that first one? Any issues at all on number 1?
Nope.
Nope.
Okay, I'll hit record. Next one says advertising. So for the advertising, again, first question, what would be the amount? Anybody?
3,000.
$3,000? That's what I got. So again, you would have taken, it's what, 70,000
72.
divided by 24 months. Again, because they said it's 2 years, which is 24 months, that comes up with $3,000. That's the correct amount. And then of course you go to your journal, and then they're debiting what account?
Advertising expense.
Yep, 3,000.
Prepaid advertising.
Very good. So we find the prepaid right there. That's all you do. So based on what I just showed you, these are both prepaids. I hit record, and of course you can then view the journal. They both look just like that. Okay, so again, all this problem had you do was record the journal entry. They didn't have you do anything with the worksheet. So the next one, which I want to show you, because there's a couple problems later on in the homework where you have to not only do this, or at least do the calculations, but I definitely want to make sure I walk you guys through a worksheet tonight just to make sure you know what to do. Okay, so that's the next one. So let's check this one out. So this is problem number 3, and this one's a little bit different, but let's just see what they give us. It says, January 31st, the general ledger showed the following account balances. So again, they give us cash, AR, supplies, all these account balances. Notice it says, assume that every account has the normal debit or credit balance. Remember the increase side, that's the review from chapter 3. Okay, they want us to complete a worksheet. You'll notice that for the adjustments, they've actually already calculated the amounts. Okay, so the point of this problem is just to make sure you know how to plug these into the worksheet to get the updated numbers. So if I went down, you see how here's the partial worksheet right here. And you'll notice that again, they've got the month, you've got the trial balance, adjustments, and then adjusted trial balance. Notice these are the exact same accounts that are given in the problem. So to start with, you just have to essentially copy, okay? So for example, you've got cash that says $63,000. You come down to the trial balance, and you simply have to enter $63,000. I go to the next one, which is accounts receivable. It says $22,500. Notice again, I'm putting these on the debit side because remember, the normal balance of asset accounts is debit. Supply says $9,000. I enter that. I go to prepaid insurance, which is $8,200. Again, debit side. I then go to equipment, which is $91,500, debit side. And then I go to accumulated depreciation, which is 0, so that's good, nothing yet. Accounts payable is a liability, $16,700. Notice I put that on the credit side. Capital is $81,950. Credit. Fees income is 117,000. Credit, remember that's revenue. And then two expenses, rent expense is 10,006. That's debit. And then salaries expense is 10,850, which is also debit. All right, now notice at this point, all I did was copy those in. That's what you'd have to do. Notice the debits equal the credits. That's just making sure that you know the correct balance. That's part of the trick, is make sure you know which side the balance should go on. Now, how to use these worksheets is once you got the trial balance in, then you got to simply put these adjustments in. Now in this one, they have already done the adjustment. If I can move this up, all right, here we go. So they've told us that supplies used during January are 5,700. So that's our adjustment. We know that's our expense. It says expired insurance is 2,050. Again, that's our expense. Depreciation expense is 1,850. So this problem didn't make you calculate the adjustment. They just want to make sure you know how to put it into the worksheet. So we'll start with supplies. It says supplies used was 5,700. So again, if we were going to do our adjusting entry, we would debit, and it's for 5,700. We would go to supplies expense. You would debit it for 5,700. And of course, you'd credit supplies for 5,700. Notice, again, on the worksheet, you'd have to put it, you'd have to put it in the adjustment column. There's supplies expense, there's your debit. And then for supplies, there's your credit. Okay, so essentially that's how you do it for that first transaction. The second one says expired insurance 2,050. So I'm looking for insurance expense. There's my debit, and then prepaid insurance 2,050 credit. I'll stop at a question so far.
Not yet.
Okay. Third one has depreciation is 1,850. So I put that down at the bottom. Debit depreciation expense, credit, accumulated depreciation. Notice again at the end that we've got your debits equal your credits. These are the three adjustments. This is how you would put it into the worksheet that they're having you do. Notice that I didn't do the journal entry, which I can if you want me to, but you know, all these would also be journalized. That's how typically you would do it. But again, the point of this problem is I want to make sure you know how to put these into the worksheet. So before I get to that third column on the adjusted trial balance, are there any questions?
No.
All right, cool. So the last step then would be simply, now that you're on the adjusted trial balance column, now we have to take what's in the trial balance and then add or subtract the adjustments. So we'll start with cash. Cash is 63,000. Notice there was nothing affected cash. The next one was accounts receivable. Just carry that over. Now I get to supplies. Somebody tell me what would be the balance that I would need to put in here for supplies.
Debit
3,300.
300.
How much?
3,300.
Very good. 3,300 debit. Any questions on where that number is coming from?
No.
9,000 minus 5,700, right? That's a debit. Subtract out the credit. That should be what's in the ledger. Okay. How about for prepaid insurance? What would be the balance you want to carry over?
6,150.
How much? 6,150?
Yep.
Yes.
Debit balance.
Yes.
Again, all you're doing is taking the 8,200, subtracting out 2,050. There's your balance. On the next one, there's nothing. You just carried over. Equipment's 91.5. For accumulated depreciation, that's the only number you just carried over. It's pretty easy.
Yep.
Accounts payable just carried over, 16.7. Same thing with capital. And then you've got fees income. And then you've got rent expense. And then you've got salaries expense, 10,850. And then the two new ones, you had 5,700, and then you had 2050, and then the last one was 1850. And then notice, once I've entered these, notice that your debits still equal your credits.
Yes.
Okay. Now, it's possible that we could have messed something up. I know these are correct, but you know, just because these are equal doesn't mean that's wrong. But I'll tell you, if you get to this bottom step and they're not equal, then you know definitely something is wrong. Okay. But that's how you do it. You copy, initially they will give you a trial balance, and then this problem, they gave you the adjustments. If they did not give you the adjustments, then of course you might have to calculate them, but still, this is how they want you to enter this into the appropriate column. And then when you do your adjusted trial balance, you're simply just updating these trial balance account numbers by either adding or subtracting the debit or the credit. And then when you get to the end, your debits still equal your credit. So again, this is just a tool that you're going to need to use in this chapter to do some of your homework problems. So I want to make sure I walk you through at least one of these. And then I think some of the other ones I already have video illustrations in Blackboard. So when you get to some of the later problems, if you get stuck as you're practicing this week, first go to the Blackboard videos first on the homework videos and see if you can figure it out. Of course, if you can't, let me know. You know, send me an email this week, or of course next Monday when we recap and finish this stuff up, you know, ask me then as well. It's no problem. Okay. All right. Questions on what I've showed you so far on these type of adjustments? They keep this stuff pretty basic up to chapter 5. When we get to chapter 12, they take the gloves off. They hit you with a lot of them. So not just that, these are just the expense adjustments. Later on, we're going to have revenue adjustments. We're going to have what they call deferral adjustments. We're going to do what they call accruals, where that's where we have expenses and revenues that we haven't initially recorded, where we're going to have to estimate or predict what they're going to be. And we're even going to do some interest expense calculations. I'm going to show you how to do some principal rate time calculations and how you do some adjustments on those. So there's a lot of stuff coming later on, but at least in this chapter, I like how they kept it very basic. These are called adjusting entries. You have to update certain ledger accounts before you get to your financial statements, because your income statement and balance sheet are impacted on every single adjustment. If you look at these adjustments, right? Supplies, prepaid, accumulated depreciation, those are asset accounts. And then of course you've got supplies expense, insurance expense, depreciation expense. These are all income statement accounts. If we do not record these adjustments, then eventually when we get to those financial statements will not be correct according to the time period. Okay, so I'm trying to break this down as best I can to get you to kind of tie in the concept of adjustments relate to time periods. And so those dates that you see on a financial statement, this one is going to be for the month into January. It's actually a very big deal in the real world of accounting and corporate accounting. These dates mean a lot. Okay, if there's ever a lawsuit, and there's believe me, there's, you know, right now, you know, some of these big companies that are just multi-billion-dollar companies like Amazon and Walmart, you know that they're always there's always litigation. There's always people suing them, because, you know, in America, you can sue anybody, right? And what happens is if something happens and you're harmed or you feel like you're unjust, and you could sue them for anything. Now, these companies have big pockets, but they're constantly being sued, and sometimes it could be even fraud related to stuff they've reported on their financial statements. And so sometimes a lawsuit can come down to the particular date of a financial statement, and maybe an investor could be suing Walmart for not disclosing certain expenses, or they're leaving out certain revenues, which impacts financial statements. Well, if it ever gets down to a lawsuit and it has to go to court, and it does sometimes, the first thing that comes up is you look at the time periods. And that's typically it's very legalistic. And these dates mean everything to these firms. When the independent CPA firm comes in and audits these financial statements, They have very clear set of rules they got to follow in terms of the time period of when the financial statement relates to, as well as to the time period in terms of when they report on those financial statements. All right. So just like, for example, let's say Coca-Cola follows a fiscal year end of December 31st.
Yeah.
That means that when they do all their adjusting entries and do all their financial statements for the year ended December 31st, which means that's January through December, they typically get audited within, by the time we get to February, that's usually when they've been audited. And then usually what will happen is their financial statements will go public to everybody in the month of March. Usually it's February or March when they get published, but they cannot get published until they've been audited. And so it's all about time. Again, just I'm giving you more stuff that's in this chapter, but I'm just saying, just remember time periods, very important in the accounting world. Okay. All right. All right, questions. There's one more I want to show you. I'm not going to do all the homework with you because it's the beauty of learning this stuff is you need to do these. Let me show you one more. This was the first three. So number 4 shows you a couple of things. And this is kind of what I was just saying. So let's read this one. And I'm not going to give anything away just yet, but I want you to think about it. It says, assume that a firm reports net income of $135,000 prior to making adjusting entries for the following items: expired rent, depreciation expense, and supplies used. So what they're saying here is they've reported a profit of $135,000, but they have not recorded any adjusting entries. Okay. The question says, assume that the required adjusting entries have not been made. And here's the question: what effect do these errors have on the reported net income? So think for a minute. These are 3 different adjustments. How would they impact net income? Does anybody know?
Income is overstated.
Some would be overstated. By how much?
Wait, what?
You'd have to add them up, right? 10.5, 12.3, and 5,400, right? So that, if I added these up, I came up with 28,200. I don't know if you guys get, but so Daniel, you would say net income would be what?
I got
Overstated?
28,100.
28,001. Let me check my math. Yeah, I got 28.2. Did anybody else get 28.2?
Yeah, I got 28 too.
Yeah, I believe it's 28.2. I mean, I'm not going to hit
Overstated
check.
by 28 too.
Yeah, you can go ahead and double check that again. But does anybody have any questions on this question? I mean, I don't want to. I'll probably stop on this homework problem because I don't want to work them all with you. You need to work them on your own, learn the stuff. But does that make sense? Any questions on how these adjustments impact income? These are all expenses.
You're right, 28.2.
Yeah. So remember that when they say expired rent, that means rent expense. Okay. Of course, depreciation expense. When they say supplies used, that means supplies expense. Now, of course, they say errors, right? You know, there's a fine line between errors and fraud, and I typically call that intent. So whether you intended to not record them or you just did it by mistake, that's actually 2 different issues. Just like you have what they call tax evading, which is illegal, or tax avoidance, which is quite legal as long as you're following the rules. But it's all about intent, as long as you're following the law. But if you fail to do this stuff, even if it was an error, in the accounting world, they would call that incompetence. And guess what? You could still be sued. I had, years ago, I knew of a story. I had a friend that he was an internal auditor at one of the big firms here in town. And he used to tell me part of his job was is he would travel. I think he did a lot of trips to Germany. I think it was with Emerson, the company in town, Emerson. And he would tell me some of the stuff that they would do, some of these local locations, is they would not do their adjustments on purpose, because if they recorded the adjustment, that lowered their profit and they wanted to get their bonuses. So sometimes they would intentionally not put in some of their adjustments just so that they would get a larger bonus. And of course, there's a whole lot of ethical issues that are wrong with that. But number one, if GAAP, generally accepted accounting principles, says you got to do it, then you better do it. Of course, I just keep in mind, this is all GAAP. And if we fail to do it, then you're violating the GAAP rules, which is law. And so it's not just about being ethical. If you're violating it, in some cases, if this is like a public firm, like a publicly traded stock firm, like let's say Amazon or Walmart, and they have a violation, it's not just by they're saying they're going to slap you on the wrist. There could be significant fines that's laid down to some of these companies, just to set an example. In some cases, depending on what the thing is involved, if it's a fraud case or something like that, there could actually be jail time, and that happens too. Okay, so that's where typically you might hear about the SEC steps in. Securities and Exchange Commission. That's the top government body that typically, when it gets to that level, they tend to step in and they'll take a look at your records. They can do that. Okay, and there's a lot of stuff that happens. So when I say GAAP, generally accepted accounting principles, those are the rules. Again, just to kind of not to repeat chapter 1, but those are the rules. And I went to an ethics seminar last fall when they were still having stuff in person here in town. The guy from Enron was there to speak, the CFO, the former CFO who had done some prison time. And we had a discussion. Part of his presentation was on this thing called GAAP. Well, of course, we were talking about the rules, and it's too much to talk about tonight, but the interesting thing that you kind of take from his presentation is, we live in this world where we follow these rules, and in accounting, it says, as long as you follow the rules, which he did, you think you would be okay. Well, the guy followed the rules and he still went to jail. How could that happen? And long story short is he said, well, look, he brought up some of the issues and some of the ways that they twisted the rules to make their profits go up. And he talked about, hey, look, we made sure. He even talked about when they were doing some of the stuff they were doing, they would have all their top people, their top executives that knew the law. They'd have their top CPAs, and then they say, look, can you do this? And they say yes or no, you can't. They knew the rule. They followed all the rules. But what happened was, the part of the rule, there was some gray areas in there. And that's the part that got them into trouble. It wasn't the fact that they didn't follow the rules. It was the gray areas. And when I was sitting at this lecture, I was like, I understand what he said completely, but in the end, they knew that by twisting some of the GAAP rules, they were actually, misreporting their income. So my point is, they knew what they were doing, but they were just trying to follow a legal rule, saying, hey, look, yeah, this may be technically incorrect, but we were still following GAAP, so you can't get us. And guess what? They did get it. And so, there's anytime you get to some of this judgment stuff and the gray, and there's a lot of gray in this world. There's not just black or white, and right or wrong on some of these rules. There's a lot of this judgment stuff, and anytime, sometimes I always used to sit back and say, well, I was always taught in school that you always follow GAAP, unless by following GAAP, it's going to misrepresent the financial statements, because every year FASB is rewriting rules because companies find these little loopholes to interpret the rules, not how they intended. So FASB is always on these companies in terms of what they're reporting. But I was always taught by my professors, and it's still taught these days, is that you follow the GAAP and you disclose everything in your financial statements that you're doing. But anytime you do not follow GAAP, which sometimes you can, it's permissible only if the goal is if you were to follow GAAP, if it misrepresents your financial statements. And that's the one thing that this I think it was Andrew Fastow or Fast, I forget his name. That's the one thing I felt like he didn't get, was that he followed GAAP, but they misconstrued it so much that they knew they were misrepresenting the financial statement. And in the end, he did 6 years hard time in a maximum prison. So, all right, so enough about that. So again, this is just to show you that these do have impact. These adjustments do have impacts on your financial statements, and you've got to do them. Okay. All right. So that was 4, and I think you've got 8 of these problems in Connect. You got to get these done. Now, keep in mind, I'm not going to set a due date on the Chapter 5 assignments or anything in Chapter 5 until probably the 25th of October. I'll put right now. The due date says like December. So, just a couple things, and I'll pause and I'll see if there's any questions. Just remember, Chapter 4 is due by Sunday. If you haven't done it, I think a lot of people have already done it, but if you haven't done it, it's due by Sunday. This week, you need to be working on your Chapter 5 homework. Go back and watch my lecture video, watch my homework. I got some textbook illustrations and some homework illustrations. Watch those in Blackboard and get stuck. Practice your Chapter 5. Try to get as much as you can done. What I will try to do with you at our next meeting is I'll recap Chapter 5, see if there's anything else going on with Chapter 5, and then of course the due date would be the following week. So you got some time on this, and then next week we would then get into that last sequence in the cycle, which is looking at what they call closing entries. Okay, so that's kind of where we're headed. To predict your next test, I believe it'd probably be that first part of November, just to kind of, because I think next week would be Chapter 6. Actually, it could be towards the end of this month. This is what, October 12th. So let me say it again. It's looking like that second exam could be possibly that last week in October, but we'll see. We'll see depending on where we're at next week. We'll see what your questions are next week. And it seems like Chapter 6, there's always it's kind of weird when we get to the closing entries, but we'll see how that goes next week. But so I'll stop for a minute. So any questions up to this point of what I've tried to get through tonight on adjustments or adjusting entries, anything at all? I would expect probably more questions next week once you've started to practice and get into this stuff. So I know I'm a little bit early tonight. I don't want to work all these problems with you, but these are really good problems. I think you're going to learn more by going in and really starting to practice somebody. So I know I'm only at 9:26, but at this point, I don't want to. I'd rather you take the rest of these the rest of the week. There's only 4 more in the homework, by the way. And then, of course, you've got the quiz to get that in. You got a couple weeks to get that in. But is there anything else that I can assist anybody with anything I've said tonight?
Not that I know of.
All right. So if not, I'm going to wrap this up here in a couple minutes. But and I can stay on up until whenever, if anybody has any other questions or needs some help. If there's nothing else, I'm going to wrap this up here in a minute. But so, if you haven't yet, Chapter 4 due by Sunday, start working on Chapter 5, watch my videos, start to practice these in Connect. If something comes up this week before our next meeting, just send me an email. I'll try to be as responsive as I can. And then next week, we'll wrap up anything in Chapter 5 and then transition into Chapter 6 as well as a preview where we're headed. So
I'm satisfied.
very good. All right, cool. Now keep in mind, this chapter, they kept this adjustment stuff real simple, real basic, which I'm very glad they did. So what'll happen is when we get into Chapter 12, that'll be probably mid to late November when we get to that. We're going to take this same concept and it's just going to explode. We're going to do all sorts of different types of adjustments. We'll do revenue and expense adjustments. So this one, we're just doing some, what they call the prepaid expense adjustments is what we're doing in Chapter 5. So just get the basics down now. And then once we get to Chapter 12, we're going to hit this again. And we're going to do just about all of them, at least all the different categories. And usually when we get to that one, we'll definitely probably spend two class periods, at least 2 weeks on that one. just because I don't think I can get them all in one night, in 1 week. So, but if there's nothing else, let me wrap this up. If you need to get out, it's about 9:30. That's a good time. And then throughout this week, something comes up, email me. And then we'll meet again on Monday next week, which, guys, that'll be what, the 19th already? That's crazy. I think we're done. Guys, by the way, I think, you know, today's Columbus Day, so we didn't get today as a holiday, but I think our Monday, I think we're done with holidays for this class. I think the only other holidays that we got coming up would be the Thanksgiving, which that doesn't impact this class because the Thanksgiving break is, I think it starts on Wednesday. And I think that's it. So we're good to go on every, we had the Labor Day. I think that was our only holiday. I think we're good to go. I think the other fall break day is on a Tuesday, so that's not going to impact our meeting. So, you know, we're pretty good for our meetings. We got every Monday, you know, for the rest of the semester, barring internet outage. Even if there's a snowstorm, it doesn't matter because we got internet. We're on virtual, so we're in pretty good shape, I think, on time. So, all right. So let me wrap this up, and if you need to get out of here, that's great. I can hang on here for a few more minutes if you need me to. Just let me know. Ask if you have any questions. I don't see any chat questions coming up, which is fine. But if you think you guys are pretty good for this week, we'll wrap it up. And then we'll see you guys next week to finish up anything in this chapter, and then, of course, to transition into chapter 6.
Thank you.
Okay, Dan, anybody else? We're good?
Nope.
Yep, we're good.
All right. I will get this video downloaded of tonight's recording. I'll get this uploaded tonight in Blackboard. So if you need to go back and reference this anytime this week, it should be up before midnight. So, all right.
Thank you.
All right, guys. Have a good one.
All right, you too.
See ya.
Thank you.
All right.